Well, greetings, everyone, and welcome to the September 2023 review. Well, there's red on the screens. The barricades are being manned. Respectable people are retiring to the countryside. Ladies and gentlemen, we are in the early stages of a bond market revolt. Now, just like historians will have different opinions on the cause of the Peasants' Revolt or the French Revolution, investors will have different explanations for the root cause of this bond market revolt. We intend to spend most, but not all of this video focusing on our explanation and its consequences for investors in other asset classes, particularly equities in which we invest. By popular demand, we will also climb back onto our soapbox to give our unique perspective on this month's ESG news, including Rishi Sunak's rethink of net zero targets. How dare he, says Greta. Naturally, we disagree. But what happened in September and what were the key events? Well, during the month, equities were down again for the second consecutive month. The Federal Reserve kept its Fed funds rate at 5.5%, but they reiterated their higher for longer interest rate view by also removing two of the implied cuts from the dot plot for 2024. In Europe, the ECB raised its key deposit rate by 25% to 4%, but indicated also that they thought that monetary policy was sufficiently restrictive, whilst the Bank of England left its base rate on hold at 5.25%. The American economy showed signs not of slowing, but of re-acceleration, with a big rebound in ISM manufacturing and services surveys. Jobless claims also trended lower, job openings trended higher, and capital goods and retail spending also went up. So subsequently, it was a big month for the dollar, which rose 2.5% and 4% against the euro and the pound, respectively, with the market concluding that the US economy can tolerate higher interest rates than its peers. This also had an effect on the Treasury market, with the 10-year Treasury ending with a 4.6% yield to maturity, having broken 4% in August for the first time since last October. It's now at 4.75%, which is the highest yield to maturity since 2007. So stocks were down, bonds were down, oil was up. It seems to me like it's the 1970s redux, which we've been talking about for the last 2 years. So amid the turmoil, obviously, uncorrelated returns were very valuable, and Phoenix from the Flames, the Argonaut Absolute Return Fund, returned 1.6%, demonstrating again the value of an uncorrelated return. How did we do this? Well, please refer to our monthly fact sheet for details. Let's move on to the main course of this month's video, the bond market revolt. So what we've been witnessing in the Treasury market is, although the Federal Reserve have been holding interest rates, longer-term interest rates, which are determined by the market, have actually been rising. And this has perplexed many market participants, given the ongoing moderation of headline inflation measures and the real risk that a 500 basis point increase in interest rates over the last 18 months would cause not only a slowdown, but a recession. So our view is that, yes, the US economy is proving more resilient to higher rates, partly because of the lag effect and the need not to yet refinance. But the key reason that few people have been talking about until recently has been the incredible deficit spending that is still going on post-COVID, in peacetime, and with full employment. And as we talked about last month, this would have had Keynes turning in his grave. The US Congressional Budget Office has recently estimated that the fiscal year federal deficit is on track to double from $1 trillion to $2 trillion in 2023, and that's 8% of GDP. it would seem that only politicians still believe in magic money trees. But there's an election next year, so palms must be greased. You might also remember that this time last year, President Biden, in an ice cream parlor in Portland, Oregon, was explaining to the world, and particularly to UK Prime Minister Truss, the mistake of fiscal stimulus at the same time as central banks were tightening monetary policy to combat inflation. Well, as a result of his own fiscal stimulus, which, by the way, has focused on government spending people's money rather than letting people spend their own money, as a result of that fiscal stimulus, stimulating the economy when the Federal Reserve has been trying to slow it down, Fed funds have actually had to go higher and higher. Loose fiscal policy has resulted in tighter and tighter monetary policy. And it's perhaps true to say that without this reckless fiscal stimulus, the world may now, in fact, already be in a 3% interest rate world rather than a 5% interest rate world. Biden's deficit has become a beast that needs constant feeding with investor capital. The current strength of the greenback reflects speculative capital flows based on loose fiscal policy, which requires ever tighter monetary policy. The current 2 trillion primary deficit compares with the total amount of treasury bills, notes and bonds outstanding of 25.5 trillion, on which the current interest charge is an annual $800 billion. And this will rise as those bonds mature and get refinanced toward 5% rather than the weighted average of 3%, which they're currently at. Now, the problem is that the biggest owners of treasuries, the Federal Reserve itself, which owns 20%, and foreign investors, which own 30%, notably China and Japan, have been selling. And the Federal Reserve states that it wants to sell 1.1 trillion of treasuries a year. In addition, around 5 trillion or 20% of US government debt is currently in bills of maturities of less than 12 months. That's fine as long as when they mature, the capital is reinvested back into treasuries. But all of this means that there's a $4 trillion annual net supply imbalance in the US Treasury market, which requires speculative inflows from foreign investors, or alternatively overseas repatriation of US investments, which private capital must fill. And this $4 trillion funding gap compares to current institutional ownership of the Treasury market of just 8.8 billion. In other words, every single institutional investor, whether it be a bank, a mutual fund, a pension fund, whatever, will have to increase their treasury ownership by at least 50% just in the next 12 months to fill this gap. And they will have to keep buying more until the ownership of the treasury market has completely changed. But here's the problem, which politicians don't seem to realize, that central banks are no longer printing money. So every new investment must now be funded with a sale of an existing investment. In other words, feeding the beast requires the sale of other assets and the repatriation of foreign investments back into dollars. And this feeding of the beast crowds out all other investments. And as we've said previously, it has the potential to cause a 1987-style stock market crash. Let's move now to ESG Corner. Well, September also witnessed UK Prime Minister Sunak backtracking from some of the more egregious government arm twisting on net zero, and also calling for an honest political debate on its pace, if not yet the end goal. We believe this, along with similar announcements elsewhere in Europe, marks a watershed moment in breaking the economically masochistic political consensus. Once politicians realize net zero isn't the vote winner they had previously believed, a proper democratic debate involving accountability for decisions based on cost-benefit analysis should lead to more rational outcomes. But as befits a parasitical industry, which only invests in companies that require government support, the ESG industry has thrown its toys out of the pram. In our view, the ESG gravy train left the station a long time ago. Every ESG stock has either imploded or is in the process of doing so. Why is this? Where and always the energy transition seeks to replace an economically superior with an inferior product. Consequently, it requires three things. The first is free capital, either through zero interest rates or ESG, or a combination of both. Secondly, it requires government subsidies, which take from the productive economy and allocates to the unproductive economy, which is totally unsustainable. And thirdly, it requires a command economy to basically ban everything else that's more useful. Without this unholy trinity, the energy transition cannot be sustained. And without it, the wisdom of the invisible hands of markets would have already consigned it to the dustbin of human folly. In the absence of central bank quantitative easing, there is no longer unlimited capital to fund multiple misallocations. Investments and investors must now stand on their own 2 feet. We are about to see what is really sustainable now and what was always parasitical, calling itself sustainable. So let's recap. Interest rates are at dangerously high altitude. Government spending isn't sustainable and can't be funded by private capital markets. So something's got to give. It's either risk assets or the economy. And if the economy gives, that won't be good for risk assets either. So it's tails you lose and heads you also lose. So for investors, this is a time to be cautious. I think we've demonstrated with the Argonaut Absolute Return Fund a unique profile which has delivered in difficult times, and compared to other equity funds, we will stand out when the going gets tougher. Over the long run, I would recommend investors watch our documentary video on the benefits of diversification for investing in uncorrelated assets, and in particular, the Argonaut Absolute Return Fund.